Okay, hello, welcome back. This is Roger Royce, host of the 10,000 Startups podcast. I'm a partner with Haynes Boone in Palo Alto, California. I do emerging growth and venture capital. And today I'm here with Francie Johnston, who also works with me at Haynes Boone in Palo Alto. And today's topic is a big one. We're going to go over a venture capital preferred stock term sheet and kind of hit the high points for those of you startup companies out there that expect to hope to someday go talk to a venture capitalist. So thanks for being here today, Francie. By the way, it's Casual Friday here at Haynes Boone. I'll tell you, since COVID, Casual Friday means something way different than it used to. I remember when I started out, Casual Friday meant you wore a less conservative tie. And now it's like, maybe I'll comply with that no shirt, no shoes rule. It's gotten very casual. Anyhow,
Indeed.
thanks. Huh?
I said, indeed.
Yeah. So let's take a step back. This is financing term sheets. And so the first step for a startup company that actually is going to go out and do what we call a priced round. That means they're selling equity, they're selling stock, is that the investor is going to present to the company a term sheet. And then we have a negotiation. And that's what we're going to go through. And the one thing that we're not going to help you with that you, the founder and the investor, have to hammer out is going to be valuation. And that'll be in the term sheet. And the first thing I want to say is an overriding principle, because I think of term sheets in two categories. It's economics and it's control. And on the economics, don't get too totally 100% hung up on valuation, because you might get a really great valuation in a term sheet, but then they take it away through other sorts of sneaky provisions. So just keep that in mind. But we're going to go through what those other provisions are. So anyway, so we're going to take a look at the National Venture Capital Association standard term sheet. And, it starts out with some factual stuff, right? Who the investors are, when you expect to close, how much you expect to raise. And that will usually include money that comes in from conversion of existing safes and convertible notes. We'll have another session on safes and notes. And then, of course, the price per share, which is the valuation. So like I say, that's just business terms. Now, beyond that, Francie, I noticed then it talks about this idea of pre-money valuation. Can you tell us what that means? What's a pre-money valuation? And then it says a fully diluted post-money valuation, including an employee pool.
Yes. So that has, become a big issue in many financings, especially when you have converting securities such as promissory notes and safes. Pre-money means that it's the value is based on the total outstanding equity of the company prior to the financing. And so, and that can, or sometimes it does include conversion of outstanding notes and safes. And that's fairly straightforward to calculate. When they talk about a post-money valuation, that would be after the money has come into the company. And so, in a simple way, you could say, well, it's the pre-money valuation plus the amount that has been funded. But calculating percentages on a post-money valuation is always trickier than pre-money, because you can get into multiple post-money conversions and then circular formulas. And so you have to be pretty careful about what happens in what order in order to make the calculations come out.
Yeah, it can be really complicated these days when you've got, a bunch of different safes or convertibles of all different terms. Some are pre-money, some are post-money, different price caps, and they're not always super clear on, which one converts first and stuff like that. Yeah, we've been through that. That's why I like this. My practice has been just to attach pre and post money cap table to the term sheet and say, this is where we're going to end up. You put in this much money, this is what you're going to get, Mr. Investor. And that way we don't have any confusion about that or disagreement or, my math is better than your math kind of thing.
Yeah, yeah, we do see a number of term sheets where they will say, uh, the investor is investing X million dollars based on a pre or post money valuation of Y, but they don't say actually what the price per share is. And then that takes more time to figure that out. And as Roger said, there are different ways that people approach that. And we've seen some very complicated pro forma spreadsheets. And often they do have circular formulas in certain cells. And, I've seen people just give up and say, well, we're just going to, budget.
Yeah.
And, we're just going to live with this circularity and it's good enough. And,
Right, right. And then warrants,
Yeah.
a lot of companies have warrants, and that, that can make it even more complex.
Mhm.
So I notice, often, almost always now, we're gonna say that the VC, the investor, is getting X% of the company on a post-money, based on a post-money valuation, including an employee pool.
Mhm.
And that's an important term, isn't it? That's not one we can gloss over. What do we mean by that when we say including an employee pool?
Well, that of course is the equity incentive plan that makes Silicon Valley great, where employees are awarded options or possibly stock, but usually it's stock options to get skin in the game. And VCs in particular will want to reserve that amount of equity up front so that it doesn't dilute them after they've made their investment. And usually the company has put in place some kind of employee pool, but it may need to be refreshed at certain points. And often we see in term sheets that the company will be required to refresh the pool so that it is no less than 10% or 15% on a post-money basis.
On a post-money basis.
Yes.
So the trick there is that means it's coming out of basically the founder side.
Yeah.
Because to say that say I'm an investor, to say I've got 20%, and I say nothing about the employee pool, so we close the round at 20%, then we adopt a stock option plan, well, I get diluted just like the founder.
Right.
If I say I have 20%, with that parenthetical, including the employee pool, that means that I got 20% counting the employee pool, so the founders get diluted.
Right.
It's a little bit of a tricky term that we really have, and that's why the what ifs
Yes.
are important on the
Yeah.
Excel.
Yeah, again, the pro forma can get kind of complicated because people need to increase the pool and tweak it and make sure that it gets to the right percentage on a post-money basis. And again, that can create circularity when you've got one party trying to own 25% post-closing and somebody else trying to own 10% post-closing. And it just, they each cannibalize each other's percentage.
Right. Okay, next big term that I find in term sheets is dividends. I think I can count on two fingers the number of times I've seen a startup company pay a dividend, but nevertheless, there it is. And the usual language is dividends are paid on the preferred stock on an as converted basis, when, as, and if paid on the common. Why is that language so important?
Well, it's important because, as you said, private companies rarely declare dividends. And so in, almost all the cases that, we've been involved with, dividends are sort of a non-event. If they're not declared, then nothing gets paid.
Right. Now, sometimes you see it's a cumulative dividend. What's the difference?
Well, the cumulative dividend doesn't necessarily need to be declared. It accumulates, pursuant to the terms set forth in the charter. We have seen that. What happens is if a cumulative dividend is accumulating over a number of years, I have seen instances where it can actually get very large. And when the company liquidates, if the cumulative dividend is part of the liquidation preference of the preferred, that really cuts into what is left over for the common holders, who are the founders.
Okay.
And it means you have to get a much higher valuation for the company to be sold in order for everybody to get something if you're going to pay the preferred holders together with their dividend first.
Right, so it's like interest on a debt.
Yeah.
It's like compound interest even, isn't it?
Yes.
Sometimes it says compounding and accumulating.
Yeah.
You used a term there that is kind of the guts of the economics, and that's
Mhm.
liquidation preference.
Mhm.
Can you tell us what you meant by that?
Yes, so when the company is ultimately sold or goes out of business or whatever, the assets of the company or the value of the company is distributed to the stockholders. And the main, one of the main advantages of holding preferred stock, which is what equity investors want to purchase, is that they get paid ahead of the holders of common stock. And usually we see a liquidation preference, which is basically just the price per share that they paid for the stock. And that would be called 1x, 1 times their purchase price. From time to time, we do see higher liquidation preferences, which, we've seen everything from 1.5x to 2x or 3x, but not so much recently. I think during the dot-com bubble, I was seeing kind of inflated liquidation preferences, but not so much now.
Yeah, I mean, 20 years ago, it was all over the place, but
Mhm.
now it's, so 1x means they get their money back
Yeah.
before the common get anything, unless they convert to common, right?
That's right. And so that means that they're actually capped at that liquidation preference. So if you get your money back, that's just what you get. You don't get to participate with whatever is left over for all the stockholders, after the preferred liquidation preference is paid, unless you have what is called participating preferred. So if you have participating preferred, you get your money back first, and then you would actually participate with the common in the distribution of the rest of the assets. So there isn't really any incentive to convert.
Right, you get your money back first, and then you get your pro rata percentage.
Yeah.
So if I have 10% of the company, I put $1 million in for 10%, I get $1 million plus 10% of the sales proceeds.
Yeah.
And that's almost always capped though,
Yeah,
isn't it?
yeah.
Yeah.
Well, almost always.
Yeah.
We have seen a few, pretty aggressive investments where it isn't. But usually it's capped, which means that if there's a fairly high valuation on the company, the preferred would economically be better off to convert their preferred to common before the liquidation distribution proceeds are paid, because they would actually get more money as a common holder than as a preferred holder.
Yeah, how often do you see participating preferred anymore, realistically?
Hardly at all, except in the case of a troubled company. If you have a troubled company that is doing a down round, and it may be that prior equity investors are having to put in more money, and and the company's not, is on shaky ground, they may want a participation right, that all sorts of more onerous terms, pop up
Right.
for trouble, down rounds.
Okay, moving on from the economics to the management and control, let's talk a little bit about voting rights.
Mhm.
And so typically, of course, preferred stock will vote along with the common on a 1 share preferred gets 1 vote, just like 1 share common gets 1 vote, except for what we call protective provisions. Can you tell us what those are?
Yes, so we see in practically every deal, that the preferred holders will have a separate vote on certain actions that the company might take, that the board might take, that need to be approved separately by the preferred holders, and not just as part of the overall equity pool. And things in particular, things that would impair the rights of the preferred holders generally have to be approved separately by the preferred. And it can also be a class vote, so all the preferred has to approve it. And we often see series votes. that, if you've got series A, B, and C, that the A holders have to approve anything that impacts the A, and the B have to approve anything that impacts the B negatively. And usually we see the language in the term sheet that any stock, if the company wants to issue a new class of stock or a new series of stock with rights, preferences, or privileges senior to or on a parity with the existing preferred stock, then that has to be approved by the preferred holders.
Yeah, it's a pretty long list, isn't it, of major decisions?
It can be,
Yeah.
depending on, how detailed and savvy the investors are. Usually there are several that show up in every deal, and they're also sort of governed by Delaware law that you can't, do something to impair the rights of a series or class of stock. A lot of times you need a separate vote to dissolve or liquidate the company. And also, if you want to sell the company, a liquidation event. Under California law, which we, are practicing mostly here in Palo Alto, that's baked into the California Corporations Code that you need a separate vote of each class. Under Delaware law, you do not necessarily, and so that's why it shows up in the charter pretty much for every company, so that the preferred have that protective provision.
Right, it's why it's always Delaware, because you can abrogate class voting and have everybody vote as a single class, right?
Yeah.
Okay, let's move along. What happens if I'm a preferred stock investor and I buy stock at $1 a share, and then you turn around and the next financing is at 50 cents a share? I'm going to say, oh man, did I mess up on the valuation? Do I get any protection?
Usually that is negotiated by the equity investors, that they will want what's called price-based anti-dilution protection. And what we see most frequently in practically every deal is called broad-based weighted average anti-dilution protection. It is a standard formula. We see it over and over. And it does, for earlier investors that may have overpaid if the valuation of the company has gone down, then that formula adjusts their conversion price so that they will actually be able to convert their higher price stock into relatively more shares of common than they would have without the adjustment to their conversion price. But it is not what we call a full ratchet. And we don't see a full ratchet very often, but again, it does come up every now and then, especially for very troubled companies that are doing down rounds. And a full ratchet is where the prior price that was higher than the current price based on the current valuation is adjusted all the way down to the current price. And that is, I would say that is a very, very draconian term that, we would never volunteer, on the company side to include in any kind of charter. But we do see it when the company is out of money, has no alternative, needs cash, and people are, the investors are really trying to protect themselves, and they realize that, they may have invested previously at a valuation that was higher than it should have been.
Yeah, if you do the math, it basically guarantees the investor has X% of the company. You just don't see that in Silicon Valley. You see that in other countries for sure, a lot, but hardly ever around here, unless, like you say, it's financially troubled.
Yeah.
Hey, we've been talking about the preferred stock as being convertible. So, and can you talk a little bit about what that means and why, if I'm a preferred stockholder and I got this liquidation preference, why would I want to convert it into common?
Well, the main reason is upon an exit, if you have a very high valuation, that the proceeds from the sale will be distributed over all the stockholders. And as we discussed earlier, the preferred holders, by the terms of the charter, have a liquidation preference that guarantees them to be paid their money first. But that would be all they get unless they have participation rights, which we said were not terribly common. And so they would be capped, and then the rest of the proceeds would be distributable to all the holders of common stock, which would create a scenario in which the preferred would just get a finite amount, and then the common would get a much larger amount. However, if the common convert their stock, I mean, if the preferred convert their stock to common before the closing of the sale of the company, then they would just participate along with all the common holders and get a full pro rata share of all the proceeds. Also, when if a company has the opportunity to go public, the preferred holders would want to convert their preferred to common prior to effectiveness of the IPO, so that they're holding the class of stock, the common stock, that is now publicly being traded on a public exchange. And that would create, and hopefully, it's the next Google or something, and the stock price goes sky high, and then their common goes, becomes, immensely valuable.
Yeah. And of course, sometimes they want the right to convert everybody to common, if the company has to do a reset,
Yeah.
if it becomes troubled, which kind of leads me into my next question. What is pay to play?
Well, we don't see that. I haven't seen it that often. That is a term that gets included sometimes in the charter that basically provides that if an investor does not continue to invest, continue to pay and play, then their stock, if they had Series A, would get converted to a shadow preferred that has not got the same rights. And
Or common,
Yeah, it could be one or the other. And they lose certain rights, however it's stipulated in the pay to play clause.
It can be really painful.
Yeah, if you get totally stripped out of your preferred rights, yes, indeed.
Yeah. Similarly, redemption rights, I don't see that very often either, but can you talk about what that is?
Yeah, I think the norm is that usually the preferred stock is not redeemable, but there are sometimes investors who sort of want a safety net. And it basically is a right to sell the stock back to the company and get their money back. Usually it's out, maybe 5 or 7 years down the road, that if for whatever reason, the company is still in business, it's making, it's profitable, it has money in its till. If an investor, but the company hasn't been sold, so there's been no big payday for the investor. The investor can invoke this redemption right, and usually it has to be a majority of the holders of the series or the class in order to invoke it. And we see that usually it's not payable in one lump sum. Usually it's payable maybe over a 3-year period, and each year the investors would get back a third of their investment, and with interest, or whatever the terms are for the redemption right.
Yeah. Well, that could kill a company.
Yeah, it's a kind of a negative term, because it sort of implies that the investor may not have a lot of confidence in the long-term prospects of the company and may just want to, bail out, cash out down the road, which isn't a very, fun feeling for the company, but we do see it occasionally, but not terribly often.
Yeah, I almost hate to ask about this next one, but investor rights, and we hear about registration rights a lot.
Yeah.
What are those, and why does somebody want those?
Yeah. So investor rights are a very standard term in almost all private equity financings. These are the rights of the investors in the event of an IPO, or to cause the company to force the company to do an IPO. Now, of course, usually it's the management of the company that is eager to go public, even more than the investors. And so I cannot recall ever having seen anybody exercise demand rights. So registration rights invariably include three kinds of registration rights. There are demand rights, S3 rights, and piggyback rights. And a demand right means that the investors actually can trigger and basically force the company to do a registration statement and go public. But like I said, usually the management of the company is way ahead of them on this and wants to go public anyway. Where I have seen more registration rights come into play are piggyback registration rights, which basically means when the company is doing an IPO, if the underwriters are agreeable to it, and this is something that is very negotiable, then the investors may be able to sell some of their stock in the IPO, and that's called piggybacking on the IPO. But often underwriters don't want to kind of share that opportunity with the existing investors, and because they want to control the market. They don't want to have too much stock flooding out right at the IPO and then depressing the price. Right. All of the investors would have signed, and it's all baked into standard equity financing documents, a 180-day lockup, which basically means all the existing investors cannot start to sell their stock until 6 months after the IPO has
And the
taken place.
founders. Right?
Yes, everybody.
Everybody.
But as under some circumstances, underwriters might let the investors participate a little bit in an IPO. Usually what I think we see more is that the only time I've seen a demand registration and invoked is for what is called a secondary. And so the company will do its initial IPO, and then the underwriters sort of negotiate with the investors and say, if you guys will hold off, we will actually help the company do a secondary sale in which you can participate. And so that's your demand registration, but we want to manage it. We don't want to just have everybody all of a sudden flooding the market with shares. We want to, set the number that are included. We want it to be registered with the Securities and Exchange Commission. We want it to be methodical and supervised, and not just everybody out for themselves. Okay. So those are both piggyback and demand. The third thing I'll just mention, S3 rights. After the company has been public and its stock has been trading on a public exchange for a specified period of time, then the company is eligible to do a very abbreviated form of registration statement, which is on a Form S3, in which investors can actually sell their stock. And that is a fairly streamlined process. And so it is used by publicly traded companies from time to time to help investors get liquidity.
Gotcha. Since we're on some of these investor rights, I've heard about a right to maintain or a pro rata right. Yeah. Is that something that's regularly requested, and what does that mean?
Yes, and I would say that one is pretty near and dear to the hearts of investors, especially if they have a company that they, if they've invested early and often, and they have high hopes for the company. They don't want to get diluted by latecomers who are jumping in, when things are looking better. And so right of first offer, or pro rata right, requires the company to tell the existing investors, if they're going to go out and try to raise funds from new investors, and allow the existing investors to maintain their percentage ownership of the company by participating in the new round. Now, we see this sometimes limited to what we call major investors. And this is, I see this probably more often than not, that this right is just for major investors. So investors who have invested a substantial amount of money in the company. Because for some companies, we see, depending on if the founders are very generous and have all their friends and family and neighbors, investing, we can see very large cap tables and with very small investors. And the company does not want to have to go to every small investor who may just have put like $5,000 or $10,000 in and say, do you want the right to buy a very small piece of this new round? So usually it's limited to major investors, people or investors who own, maybe 10, 15% of the company already, and who are trying to maintain that percentage ownership.
Right. Okay. So kind of continuing on here in terms of rights investors have, are they going to want a board seat typically?
Very often they do. And that is quite common. Venture capitalists in particular would like to have a representative or a right to designate one of the board members, one or more. That's always negotiable. And if you have two major investors in a round, you may see both of them wanting their own board seat. And from the company's perspective, this is, both helpful and maybe awkward. It's helpful in that, you want seasoned, experienced investors who can, help guide the decision-making process with founders who may be on their first startup or, not as familiar with corporate governance. It can become awkward if too many people want the right to designate a director, because then, larger boards become unwieldy. Just the logistics of rounding up people for board meetings and, distributing minutes and getting consents, becomes harder when you're chasing more people. Usually companies like to have an odd number of directors, just so that if there is a difference of opinion, you don't get into a deadlock situation. I have seen recently, actually, in a couple of instances where if there was an even number of directors, then a particular director, the chairman, would be designated 2 votes for a tie-breaking situation, which I don't see it very often, but that is one way to deal with it.
Sometimes they do that. We'll have different directors have different numbers of votes. I hate making it complicated. I like to
Yes.
see a nice, simple 3-member board, one by the founder, one the investor, and third an independent.
Yeah.
What's a board observer? Because I see that a lot too.
Yeah. So a board observer is a non-voting representative of an investor who would be, in many cases, they're almost like a pseudo board member in that they're entitled to receive the board package and materials that are distributed to the board members prior to board meetings, and they sit in on the board meetings and most of the time are asked for their thoughts and contributions, but they do not vote on any matters that come before the board. So
what matters is the board going to, in particular, what does the investor have to approve if they're on the board? Do they typically negotiate for a veto right over stuff?
They can. Certainly, the main thing that the board will absolutely need to approve, and as will the shareholders, is any change to the charter, and that's what is required in order to raise new funds. If the company needs more stock to sell, they have to authorize it. And usually it's going to be a new kind of stock, a new series of preferred stock, unless there's been no change in the valuation of the company. And so this is where the board needs to approve any kind of amended and restated charter, and the stockholders also need to approve that. The board also would approve strategic transactions, loans to the company, bank deals, sometimes lease agreements, major contracts,
Stock issuance, option grants.
Yeah, the option pool.
That's a big one.
Yes. So and particularly the amount of shares reserved for the option pool. Any increase to that is dilutive to the existing shareholders. So again, that not only requires board consent, but it also requires stockholder consent.
Usually. Okay, tell me about ROFRs and co-sales.
Yes, this is again, it's a way to protect the investors, and also it keeps the founders responsible to let the investors know of any plans the founders may have to liquidate their stock. Basically, certain key employees, and usually it's the founders, maybe the main corporate officers, those people who hold a majority of the common stock, will have to give a notice to the investors if they want to sell their stock. And invariably, the company will have what is called a right of first refusal to buy any stock that a key holder wishes to transfer to a third party. And so the transferring stockholder must give the notice to the company as well as the investors. The company has a right of first offer to buy the stock. If it doesn't, then the investors would have a secondary right to buy the stock. So if they don't want it going to some third party that they don't particularly like, they can prevent that from happening. But they have to buy the stock at the price that has been offered by the third party. And if all the investors pass, because they don't really care if it gets sold, then they have what is called a co-sale right, which means that not only did they have the right to buy the stock, then they actually have a right to participate in the sale to the third party. And in this way, they would sort of cannibalize the amount of shares that the selling stockholder can sell.
And the flip side of that, of course, is the drag along, right?
Yes. So if and when the majority holders and the board feel that it's appropriate to sell the company, or they have an offer and want to sell, then everybody who's a party to this right of first refusal and co-sale agreement, which invariably very often contains what's called a drag-along right, they would be compelled to approve the transaction, to vote in favor of it, to not exercise dissenters' rights or appraisal rights, and to sell, to sign up to the terms of the sale. And usually they would be selling all their stock, or just agreeing not to exercise dissenters' rights if it's a merger.
Yeah, that last thing you said is probably the reason we have drags, is to try to get around that, because that can really mess up a deal when people are exercising
and
appraisal.
People do exercise appraisal rights and dissenters' rights, and which means that then the company usually has to negotiate with one or two stockholders separately to try and buy them out or get them comfortable with the deal. And it distracts time and attention away from the main transaction, and it unless people have signed the drag along, it can give a disproportionate power to parties that really don't merit it.
Right. And then the other big term in a term sheet that generates a lot of discussion, even though we never change it, is the no shop. Should I, as a founder, be offended if my investor asks for a no shop?
Well, I think it's only fair that the no shop, that the investor have a no shop for a certain period of time. It takes time, as we lawyers know, to get deals done. And you don't want the company out beating the bushes and talking to other people when you're trying to get a specific deal done under specific terms. Now, if it seems that the deal isn't going anywhere and it's bogging down and people are losing interest and losing momentum, at some point, maybe the company does want to move on. But, so you would never want the company to agree to a terribly long no shop, but you know, a reasonable amount of time is, I think, standard.
Yeah. Okay, so is there anything else in these term sheets, any major terms that I forgot to ask you about that you might want to call out?
You know, in addition to the right of first refusal and co-sale agreement, we do often see a separate voting agreement, which just kind of locks in which investors have the right to designate a director. And it's pretty standard terms that, you know, they can designate the director, and if they want to remove him, they have the right to remove him, or her, but you know, nobody can force them to do that. There are, you know, ancillary, you know, terms in every deal. Every deal's got its own special issues and problems, but I think we've
We hit the high
covered the high
points.
ones. Yeah.
Okay.
Yeah.
Well, we've got about double the time I usually spend on these, but there's a lot to talk about. So I want to thank you for being here, Francie. This is Roger Royce. I'm here with Francie Johnston. We're lawyers with Haynes Boone, Palo Alto, heart of Silicon Valley, and on the 10,000 Startups podcast, we've been talking about venture capital term sheets. Thank
Yeah.
you for listening, and we'll see you next week.
Look forward to doing your deal.